Hi, I'm Jenny Brown. Welcome to MFB News. A very happy new year to you all. I hope you're all doing really well. I hope you had a great Christmas, not a COVID Christmas like I had. Wow, what an experience that was. Not one I'm hoping to repeat ever again. And for those of you who had a similar Christmas this year, I hope you're all doing really well now. Now look, in terms of what we've got for you this week, it's going to be quite a quick update. The lenders have only been back for just one day, so not huge amounts of news for you. Having said that, you know, I'm never short of a few things to say, so I have got some information to cover off. We're just going to carry through a couple of changes in the market, update you with some thoughts about what interest rates are going to be doing over the coming weeks and months. Then I'm just going to give you a summary of what's been happening in the buy-to-let market, so where we are today. So for those of you who are watching this, who are thinking about investing, just really giving you a broad overview in terms of the mortgage market. And then lastly, I'm just going to share with you some data that UK Finance have released with regards to lending numbers both in 2020 and 2021 and predicting over the next coming years, which should give you some insight into what's going to be happening in the housing market as well. Okay, so first up, some lender changes. So in the run up to Christmas, because we haven't actually spoken for a couple of weeks now, there was some movement in the lending market, which was largely lenders putting rates up rather than coming down. But with all these things, what we tend to find is you always get a couple of outlier lenders who bring out a couple of limited edition or exclusive rates or just reprice downwards. And it's very, very hard, I think, when you hear that that's happening. On your one hand, you've got me banging the drum saying rates are going to go up, and then you've got other lenders bringing their pricing down. The general rule of travel, the general direction of travel is that rates are going up nonetheless. Now, in the last few days, we have seen the Coventry Building Society reduce rates on all of their 2-year fixed rate products and also their portfolio landlord product range. Coventry are a really good lender. I genuinely really like dealing with the Coventry. They're very black and white. They have a policy, they stick to it like absolute glue, but actually the policy is broad enough that it appeals to enough landlords that actually it's worthwhile. So in terms of the Coventry Building Society, or Godiva, which is their buy-to-let brand, for landlords up to 10 buy-to-let mortgage properties in the background, that's absolutely fine. Anything more than that, they're not going to lend to you. And they're lending to people rather than companies, so no limited company applications with these guys. Now, interestingly, when they're looking at applications and they're saying no more than 10 properties in the background, what they do, which is unusual, is they disregard any properties that you own in a limited company. So your 10 property allowance is only things that you own in your personal names, which actually then opens things up for quite a lot more landlords. No minimum income requirement. They're happy with older applicants. Their rates are very, very good, and the fact they've downward price is really interesting. Now, what they did do is in the run up to Christmas, their pricing actually increased. So I think this is just a rebalancing rather than a general rate reduction from these guys. Now, we've also seen Accord Mortgages launching 51 new products and withdraw 51 products, which is going to be actually kicking in later on this week. In the round, because some rates have gone up and some have gone down, there isn't really anything particularly newsworthy to report there, but just to let you know that if you have got your eye on an Accord Mortgages product, that is going to be changing later on this week. Could be in your favour and could not. Now, lastly, from lenders, State Bank of India have released some green mortgage rates. They're not bad, nothing to write home about. What's interesting is they're only available for properties with an EPC rating of A or B. All the other lenders tend to be incorporating C into that category as well. State Bank of India as a lender, I'm not going to lie, they're not my favourite lender. They have some fairly niche pieces of lending criteria, so they're able to lend to limited companies, for example. We have found their service proposition in the past to be pretty dire. We've always tried to avoid them. They've never done enough to really convince us that they've actually got back on track. And State Bank of India, if you're watching, so I'm really sorry, but that genuinely is our kind of experience of them. And I think it's really important to be honest with you in terms of our experience of lenders. But, you know, it's another lender who is pioneering the green space, which is only to be applauded. So hopefully with that in mind, State Bank of India are really going to sort themselves out in terms of service. And they're going to be a lender that I'm going to be happy to really kind of promote to you in the coming months. Okay, interest rates now. So for those of you who watch this video frequently, you will recall that I was talking about the fact that swap rates had spiked and that would mean that lenders' interest rates would go up. And this swap rate spike was in response to nervousness around base rate increase. So then what happened was Indeed, lenders' pricing did go or start to move on an upward trajectory, and then base rate went up in December. Now, the Bank of England is not meeting until February, but there's clearly more nervousness around another base rate movement, an upward one in February, because the money markets are now behaving in the same way again. So what we have seen is that LIBOR and SONIA have spiked. 5-year swap rates as of the 29th December were at 1.319%. They were sub 1% just 1 month ago. So what we're seeing here is that the cost of 5-year funds on the money markets have increased by 0.4%. I can only, leave it to your imagination, I guess, what that actually means in terms of what will happen to mortgage rates. So our message to people at the moment is this: mortgage rates are the cheapest right now that they're going to be for this whole year. So if you are in the market for a mortgage, now really is the time to try and secure an interest rate. If you're looking for a remortgage in the next 6 months, please don't wait until the last minute. You can apply for a mortgage now and essentially lock in a rate for up to 6 months with lenders who have elongated offers. And actually some lenders you can slightly even push things out to rates that don't end until July or even August. So if you are in the market for a rate, please don't wait. Genuinely, rates are going to be going up as we move into 2022. And now really just continuing the theme of that somewhat, I guess, just a little roundup in terms of where we are in the mortgage market. And this is going to be very, very high level. Obviously, if you did have anything that was particularly, concerning to you in terms of your own situation, give us a call. We'd love to just have a chat with you and just really let you know whether we can help you or not. But look, so at the moment, individual buy-to-let rates on 2-year money start from 0.99%. 5-year fixed pricing starts from 1.49%. These rates are genuinely incredible. Limited company pricing, 2-year money is from 2.44, 5-year from 2.69%, which is why I'm saying to you, the rates are really, really low. If you are going to be looking for a mortgage in the coming weeks and months, please do try and look into something now, because I guarantee you, and it's not often I say that, but I genuinely guarantee you that if you leave it for 3 months, 6 months, you're going to be regretting that decision, because the pricing will have moved upwards. Now, more broadly, in terms of lender criteria, so the maximum loan to value on buy-to-let mortgages, we're back to 85%. There's a couple of lenders playing in that space, both for individuals and limited companies. Now, at 85% loan to value, the rates are quite toppy. It certainly wouldn't work for everyone, considering as well that the rental calculation is reflective of the interest rate you're going to be paying. Therefore, properties which are lower yielding, so think properties in the southeast particularly, don't tend to work at 85% loan to value, because they just don't tend to yield strongly enough. At 80%, there's definitely more choice available, but really your sweet spot in terms of pricing is still at 75% loan to value. But look, if you've got a property where the numbers work at 85 or 80%, it's wonderful that we have much more choice than we did this time last year for sure. HMOs and multi-units. So currently we can get HMOs of up to 20 bedrooms, multi-units of up to 20 self-contained units on buy-to-let pricing, so normal buy-to-let pricing. Rates tend to start from roughly 2.99%, depending on the size of the HMO and whether it's individual or limited company. So for example, if you had a 4-bedroom HMO owned in your personal name, I would expect you to be able to get rates of significantly lower than 2.99. If you've got a 6-bed HMO in a limited company, that's kind of where you're pitching yourselves. But obviously these properties are really high yielding, so they can absorb those slightly higher interest rates. Properties which are larger than 20 beds or 20 units, so your really, really chunky blocks of flats, we've got pricing here starting from 3.99% on 5-year fixed terms, so very, very good. In terms of other criteria, so look, there's lots and lots of stuff we could go into. The things that I'm kind of having conversations with clients about, which I think might be of interest to you at the moment. So first of all, day one remortgages. Lots of landlords are currently buying properties and doing works to them. They're looking for capital uplift at the moment. And remortgages within the first 6 months of ownership are very much available. Some lenders will say, well, okay, if we're going to remortgage it within the first 6 months of ownership, the value of the property is only ever going to be what you've paid for it plus what you have spent on it, or open market value, whichever is the lower. Whereas there are some lenders who will say, well, okay, as long as you've done something to enhance the value of the property to justify the uplift, then we're happy just to take the open market value, whatever that is. Maximum ages, that's another one we're getting quite a lot of inquiries from people about. I think there's a lot of borrowers who have been on mortgages with the likes of Mortgage Express, for those of you who remember that lender. They've been paying very, very competitive standard variable rates with this lender for a long period of time, but their terms are now ending. So actually it's not that their rates are finishing, it's actually that they have to pay the lender back, and they're reconsidering their options. And by the virtue of the kind of timings involved in this, these do tend to be our older applicants. So look, there are lenders who will give you a 25-year term if you apply for a mortgage before your 75th birthday. There are also lenders who will take applications from people who are up to the age of 85 actually. So realistically, you know, if you are one of our kind of more mature applicants, don't worry, there will be someone who can help you. Another one we're seeing, and we often see this at the start of the new year, where I think people kind of think about their plans for the coming 12 months and what they're looking to achieve, is inquiries from first-time buyers, so someone who owns no properties at all. You can get a buy-to-let mortgage if you're a total first-time buyer. However, what the lenders do tend to do is apply an affordability calculation as if it were your own home, so 4.5 to 5 times your own personal income, rather than just considering the rental calculation in isolation. Why do they do this? Largely to ensure that actually if the borrower is actually sneakily doing a property to live in rather than a buy-to-let, they're not abusing the way that buy-to-lets are traditionally underwritten, so making sure that if the borrower did move into it, it would be affordable. And the last one we're seeing a lot of at the moment, and again these things change all the time, but a lot of people are looking to rent out current homes on a buy-to-let and then buy a new house to live in, so let to buys. Let to buys are very widely available from lenders, whether it's going to be that you're going to keep your current home in your own name and rent it out, or whether you're going to move that into a limited company and rent it out. Both of these options are very mortgageable. People feel that let to buys are some kind of special mortgage product. They're not, they're just a piece of lending criteria. So as a lender, do you lend to first time buyers, yes or no? Do you lend to first time landlords, yes or no? Do you do let to buys, yes or no? So if this is something you're thinking about doing, and like I say, we see a huge number of people who do this, I think particularly for experienced landlords, it's really not in your kind of psyche to sell properties. So actually if you're thinking about moving home, this is another kind of area where we can absolutely help. So look, I hope that's helpful. Obviously there are like a million things we could go into in terms of lenders' criteria, but that's a very broad brush overview about where we are at the start of 2022. Lastly this week, UK Finance has predicted that buy-to-let purchase activity would have increased to 18 billion in 2021, which is up 83% on 2020. The reason I say predicted is that the final numbers have not yet kind of been provided, so they're just providing one final estimation. UK Finance said the main driver of lending for 2021 was for house purchases at 200 billion, which was up 53% on 2020. However, homeowner remortgaging activity was slightly down last year at 62 billion. Now what they're saying is the predictions outlined for the total house purchase transactions, including cash purchases, will reach 1.5 million in 2021, some 47% higher than 2020 and the highest number since before the global financial crisis. So what this is telling us, I guess, is really what we already knew, that 2021 was a bumpy year for people buying property. But looking forwards, that UK Finance are estimating that the gross lending overall would peak at 316 billion, which is up 31% on 2020, then moderate to 281 billion in 2022 before increasing again to 313 billion in 2023. Now looking ahead, UK Finance said that while the 2022 and 23 gross lending figures will be reductions on the 2021 peak, they will be higher than the 2020 and 2019 figures, representing a return to a more stable level of activity. Now, James Tatch, who's the Principal Data and Research at UK Finance, has said that 2021 has been a bumpy year for mortgage lending amid the stamp duty holiday and home workers moving from cities. But the outlook for the housing and mortgage markets over the next 2 years is for a return to a more stable, balanced picture following the upheavals of the last 2 years. So what does this tell us if you are an investor? So a lot of landlords were put off from investing in 2021. The market was just running too hot for these guys. They didn't want to get into the whole kind of gazumping and bidding wars that were going on. The expectation is that for 2022 and 23, things are going to cool down. So there's the really good news. Now, what is not such great news if you're looking at buying a property is that whilst things are expected to cool, the expectation is that house prices will continue to increase, but on a much more kind of subdued level. So for those people who are sort of waiting to see what the housing market was going to do early in 2022 before investing, just to let you know really that the predictions are that the housing market is not going to fall off a cliff. That house prices are really going to kind of continue to be stable and increase, albeit more slowly than in the previous year. And that's everything from me this week for our first MFB news of 2022. I hope you found that helpful. I did say it was going to be quick, sorry about that. Like I said, I've always got a lot to say. So look, if you do have any questions on anything that I've discussed, any of your investment plans and how you're going to finance those in 2022, remortgaging, locking into those very good interest rates, etc., please do give us a call. We would love to hear from you. 0345 345 6788, or by all means have a look at our website, mortgagesforbusiness.co.uk. I'll be back again next week. I'll look forward to catching you then, but until then, look after yourselves and keep warm.